So you have finally decided to invest in the US stock market. Whew, took you long enough. Just kidding. Better late than never, right? If you are here watching this video, chances are you have been catching up on some financial news on our beloved weakening ringgit Malaysia, or you have some spare cash to invest. Whatever. You probably also googled what is PE ratio and more or less know that a low PE ratio is generally better than a high PE ratio, and that an analyst's recommendation should always be taken with a grain of salt. And don't even get me started on the cringy ads you see that promote stock investing like a get-rich-quick scheme. Ugh. Good on you, as you have pretty much covered the basics. But wait, with over 4,000 US stocks to choose from, how do you select a stock that's worth buying and investing for the long term? Well, you have come to the right place because this video will help you to answer the million-dollar question of how to choose your first US stock. But before I proceed, I wanted to put this disclaimer across. You know, each of us have different goals in life, and that applies to investment goals as well. Be it investing in a stock or any asset classes, you and I would have a different risk appetite and investment horizon. So do understand that there's no one-size-fits-all investment strategy. Always do your own research and due diligence before purchasing any stock. If you are keen to get a refresher, you may refer to this video for a full beginner's guide on starting your investment journey right here. Alright, thanks for attending my TED Talk. Let's get down to business. Now, do you know there are 11 stock market sectors that make up the entire stock market? This is according to the most commonly used classification system, the Global Industry Classification Standard (GICS), a methodology designed in response to the global financial community's need for accurate, complete, and standard industry definitions. Why does this matter to you as an investor, you ask? Well, the performance of each sector varies depending on the nature of the economy. Not all sectors will thrive at the same time, and to have a well-diversified investment portfolio, it is beneficial to have investment exposure to each sector at one point or another while you invest, so you can be covered at all times no matter what happens in the real world. But the reality is, while one sector may be performing poorly as a result of bad economic conditions, others may be thriving. Just like how during the COVID-19 lockdowns, the tourism sector took a plunge, but the tech sector thrived as most of us were home most of the time. But now that COVID is sort of over, everything switched places as now the tourism sector started to thrive again, while the tech sector has begun slumping due to the over-aggressive spending and hiring during the COVID lockdown. That's why it will definitely be useful to understand what each stock market sector entails and the factors that influence their performance, so you know how to position your investment portfolio as the cyclical market evolves. And as I always say, the stock market is dynamic and forward-looking, so you need to look ahead in time if you want to stay ahead of the pack. Anyways, here's a quick rundown of all 11 sectors. Number 1, the consumer discretionary sector, basically businesses selling non-essential products and services. For example, automobiles, travel, electrical products, apparel, design luxury goods, etc. The largest consumer discretionary stocks include Amazon, Tesla, Home Depot, etc. I'm sure you must have heard of them before. Number 2, consumer staples sector. Basically businesses that include manufacturers and distributors of food, beverages, and tobacco, and producers of non-durable household goods and personal products. Coca-Cola and Procter & Gamble are two of the most valuable consumer staples stock in the US stock market. Number 3, the energy sector. They are businesses that are related to the production and supply of energy, covering the companies that explore, produce, refine, market, store, and transport oil and gas, coal, and other consumable fuels. Two of the largest US stocks in this sector are ExxonMobil and Chevron. Number 4, materials sector. They are companies that manufacture chemicals, construction materials, glass, paper, forest products, and related packaging products, and metals, minerals, and mining companies, including producers of steel. Well-known material stocks include paint maker Sherwin-Williams and chemicals manufacturer DuPont. Next, number 5, the industrial sector. They include businesses that mainly produce capital goods for the 4 main industries: manufacturing heavy machinery, aerospace and defense, transportation and logistics, construction equipment, and building supplies. Some of the largest industrial companies in the world include Boeing, Honeywell, and Union Pacific. Number 6, healthcare sector. They are businesses that provide medical services, manufacture medical equipment or drugs, provide medical insurance, or otherwise facilitate the provision of healthcare to patients. Examples of large healthcare companies include United Health Group and Pfizer. Number 7, financials, basically firms and institutions that provide financial services to commercial and retail customers, covering a broad range of industries. For example, banks, investment companies, insurance companies, and real estate firms. Warren Buffett's Berkshire Hathaway and financial giant JP Morgan Chase are among the best known stocks in the financial sector. Number 8, information technology. They are basically businesses involved in manufacturing of electronics, creation of software, computers, or products and services relating to information technology. Apple and Microsoft have been switching places back and forth at the top of the list of large US stocks in the IT sector. Number 9, real estate industry. They are primarily made up of companies that own residential, commercial, and industrial real estate properties. A large portion of the companies are structured as real estate investment trusts, REITs, or we call it REITs. Among the top stocks in the real estate sector, you will also find cellular communications tower specialist, American Tower, and major shopping mall owner and operator Simon Property Group. And number 10, communication services sector. They are basically companies that provide wired, wireless, satellite, cable, and other comms infrastructure to businesses and consumers. Social media giant Meta or Facebook and search engine pioneer Alphabet are among the biggest stocks in the communication services sector. And lastly, number 11, utilities sector. They are companies that provide basic amenities such as water, sewerage services, electricity, dams, and natural gas. This sector is usually heavily regulated as they are part of the public service landscape. Utilities tend to be regional in scope, so you might have heard of Duke Energy in the southeast of the US, Consolidated Edison in the northeast, and American Electric Power across much of the Ohio Valley and the Southern Plains states in the US. Whew, that was a lot to cover. Anyways, by learning about the various stock market sectors, you can gain a better understanding about how you want to diversify your portfolio and how the market is categorized. For example, if you have a smaller initial capital but would like a diversified portfolio, you can easily do so by investing in an index exchange traded fund (ETF). However, if you are interested in investing in, for example, technology or energy-based businesses, you can of course confine your investments to only the sectors you are interested in as well. Remember, at the end of the day, it all boils down to your own preference and financial goals. If you are still watching and still not too sure where to get started, don't fret. It's a lot, I know. To get you started, here are two different methods that are widely used, the top-down or bottom-up approach. Both of the top-down investing or the bottom-up approach might sound like that boring business lesson you had back in university. Boring! But I promise, learning these two approaches is not as boring as it sounds. Top-down investing's core focus is on the macro factors of the economy. Their analysis includes 1. Economic growth or gross domestic product (GDP) both in the US and across the globe. 2. Monetary policy by the central banks, including the lowering or raising of interest rates. 3. Inflation and the price of commodities like gold and oil. And 4. Bond prices and yields, including US treasuries. Basically, all of the macroeconomic conditions that I cover on my channel every Monday at 7 PM KL time. After looking at the big picture conditions around the world, you can then examine the general market conditions to identify high-performing sectors, industries, or regions within the macroeconomy. And based on these factors, a top-down investor would allocate investments to outperforming economic regions rather than betting on specific companies. For instance, if Asia's economic growth is stronger than that of the US, an investor might consider investing in exchange-traded funds that track specific Asian countries instead. And from there, they can also drill down further into specific companies to choose potentially successful ones as their investments by looking at their fundamentals. The ultimate goal is to find a specific sector that could be outperforming the market for the time to come. That's the point of investing, right? Buy low and sell high. Unless you like to buy high and sell low, then that's a different story lah. As for bottom-up investing, it's the complete opposite of top-down. Investors of the bottom-up approach usually ignore macroeconomic factors and instead look at microeconomic factors that affect specific companies they are keeping an eye on. Bottom-up analysis includes financial statements of the company, revenue and earnings growth for the foreseeable future, leadership and performance of the company's management team, a company's products, market dominance, business mode, and market share. They often seek to identify profitable opportunities through a company's attributes and its valuation in comparison to the market, regardless of the performance of the industry or the country that the stock is in. And as for my preference, I like to combine both top-down and bottom-up investing when building my investment portfolio. I will start with a top-down approach and look for a country that's likely to see rapid growth at least for the coming decade. And in this case, I don't think there is any other country that comes close to challenging the US position as the largest capital market or threaten the status of the US dollar as the world's reserve currency. That's just not going to happen, as all the other major countries like China, Japan, UK, European countries, they are all suffering from the crisis in their respective nation. And once the analysis is done, I then take the bottom-up approach within that country by looking for companies with a strong business mode and have a much larger total and serviceable addressable market, basically your TAM and SAM. And to put it simpler, ideally you want to look for a healthy fish to grow in a big pond, rather than looking for a big fish but can only grow in the size of a small pool, because the pool can get crowded very fast and that big fish will lose to the younger and smaller fishes. I would also avoid sunset industries that have already peaked in terms of innovation, like the oil and gas industry, but that's just my personal preference. Oh, here's another tip. Instead of forcing yourself to select any of the mentioned sectors, try looking around what's around you, like literally, and you may just find some stock ideas. For example, on your work desk alone, you probably have an iPhone built by Apple, or your Windows powered laptop that is built by Microsoft. And in your living room, your television could be powered by Netflix or Disney Plus by Disney. Unless you are still using Astro then I got nothing to say lah. And for most of you, if you are using Instagram, Facebook or YouTube, obviously, they are all a form of product or services from US based companies such as Meta or Google. And with that, just have a think about the number of US based products you are consuming or using on a daily basis. Instead of just being a consumer, wouldn't it be great if you can be the owner and reap the benefits from their earnings as well? That's where stock investing comes into play. Alright, so you have shortlisted a few companies and now you are down to D1. But I must tell you, the stock picking journey is far from over. In fact, we are just getting started. Buckle up folks, now that you have selected a potential company after swiping left on so many, start paying attention to them on the news and monitor the development or trends of the industry in general. You can't be expecting to start earning profits just because you have selected the company, right? It's important to keep up with the market news and opinions, and there are plenty out there. Some of my personal favorites are Bloomberg, Morningstar, CNBC and Seeking Alpha. You can formulate a stronger investment thesis by reading financial news while keeping up with independent blogs or articles that can give you a lot more perspective towards a particular company. For example, based on my observation and research, I noticed that Tesla is at the forefront of the renewable energy and climate change initiatives. So if they can continue to offer a competitive product for consumers and also create jobs and economic benefits for any given country, as they did with China, Europe and many more, they are well positioned to capture any government incentives that boost these initiatives. There's no reason why a company that is so far ahead in almost every vertical of future technology will not succeed. Such is the case with their electric vehicle manufacturing capability and speed of production and self-driving car AI technology. They also have the fastest deploying solar and battery storage system, both at residential and commercial scale projects. Not forgetting the CEO, Elon Musk himself. Not gonna lie, he can be controversial at times, but you can't deny he is the king when it comes to garnering attention, which, hey, bad publicity is still publicity. Anything that gets attention from the public will usually translate to lower customer acquisition costs, which means more profits for the business. It's unfair, but it is just how the internet works nowadays. Here's another thing you should take note of. While certain companies' financial health may seem promising on both the numbers and their business model, you need to remember that corporate annual reports and presentation decks are all marketing materials, even if they are audited. What? And sorry to rain on your parade, but that's the truth. My point here is that it's important to be critical of your own assumptions and theories. Don't believe me? Here are some past stories that I will share with you. Theranos, an American privately held corporation that was viewed as a breakthrough health technology company, was founded in 2003 by 19-year-old Elizabeth Holmes. It was once valued at $10 billion US, and its leadership claimed it would revolutionize the blood testing industry. The so-called technological breakthrough envisioned by the then CEO Elizabeth Holmes and former company president Ramesh Balwani, however, has never been demonstrated, and ultimately they were nothing except a bunch of fraud and was charged by the US SEC. What happens afterwards is up to your imagination. Yikes. Another case was by Nikola, an American manufacturer of heavy-duty commercial battery electric vehicles, fuel cell electric vehicles and energy solutions. The founder, Trevor Milton, became a billionaire by lying to his investors about the most important aspects of his low-emission vehicle company. His case was viewed as a cautionary tale about the hazards of investing in companies that are not yet generating any sales or delivering any products. He now faces federal charges of fraud and securities fraud stemming, leading to crushing losses for people who bought Nikola stock before it collapsed. Now, do you see what I mean by how you shouldn't fully trust a company solely by its company reports or their pitches? Watch out for them, because everyone can promise, but not everyone can deliver. And let's face it, no company operates in a vacuum. So to truly understand your selected company's competitive advantage in any particular industry, you need to also look at what their competitors are doing as well. And once you have found the list of companies that you feel are most relevant to the company you're trying to value, it's time to gather their financial information. And lucky for you, with the power of the internet, you can get all the information you need with just a few clicks. Why do you need to do so? Well, by doing a comparison, this will allow you to form a baseline for where the company is in the industry and where they could be in 5 or 10 years time, which helps you to gauge and make a better decision on the company's potential. And here are the 5 basic types of financial ratios you should start consider looking at. 1. Earnings per share, EPS ratio. Price to earnings, PE ratio. Debt to equity, DE ratio. Return of equity, ROE ratio. And lastly, quick ratio. No worries, I know it's a lot, so feel free to check out this video where I've shown you step by step how to start your journey with financial ratios analysis. I'll put it on the top right hand corner for you, or somewhere around here. The results of such comparisons can mean more powerful decision making when it comes to selecting companies in which you want to invest. If you don't have access to an expensive investment tool like the Bloomberg Terminal, you can manually gather this information from annual and quarterly reports, but it will be much more time consuming. Or you can start off with free online tools like Yahoo Finance or Google Finance. It's free and has a fairly intuitive user experience. And besides financial ratios, for a competitive advantage to be established, it is important to know the 3 following items. 1. Value proposition. A company must clearly identify the features or services that make it attractive to customers. It must offer real value in order to generate interest, basically a clear why this brand or this company stands out from its competition. For example, when we talk about long form videos or tutorials, other than YouTube, what are the other platforms that you can think of? Not much, right? Number 2, target market. A company must identify its target market to further establish best practices that will maintain competitiveness instead of targeting everything. A company that is phenomenally good in 1 or 2 particular areas can easily stand out and be the choice for consumers. And using the same example, YouTube is clearly thriving because they mainly target long-form video consumers. Meanwhile, TikTok, on the other end, is mainly targeting consumers looking for short-form videos. It's just the way it is. That is why you don't see YouTube Shorts coming anywhere close to what TikTok has today. And thirdly, competitors. A company must define competitors in the marketplace and research the value they offer. And this includes both traditional as well as non-traditional emerging competition. And in this fast-moving internet age, if you snooze, you basically lose. For example, Nokia. Literally everyone in the world had one of them back in the days. But where are they today? Nada. My point is, gather this data and list them all down and do some comparison. With that, you can have a better clarity on the potential of your selected company and decide on your investment horizon or just your risk appetite. And once you have all the conviction you need, it's time to make your first purchase through a reputable and well-regulated international broker. And a personal favorite of mine would be Interactive Brokers. In case you're new, here's a full video on it. Now, once you have purchased your stock, congratulations, a milestone achieved.
Nice.
By purchasing a stock, you are essentially owning part of the company. Now, let's say a company has opened up 100 shares for sale. Each share worth $10, so the current value of the company is $1,000. And if you bought a share for $10, you can then effectively own 1% of the company. And besides that, there are 2 ways you can profit from it. 1. You can receive dividends. When a company makes money, it can share its earnings with its shareholders. And in this case, we are the shareholders. But dividends are not guaranteed and a company can stop paying them at any time. Typically, more mature and established companies pay dividends, usually on a quarterly or 3-monthly basis, while newer companies do not. Startups or younger companies are more likely to report losses in their early years or reinvest any profits back into the company. But here's the catch for US stocks dividends. Any dividends paid by US domiciled companies, or funds to non-US residents from countries with no tax treaty with the US like us will be imposed a 30% dividend withholding tax. And to understand this further, I've explained more here in this video right here, so feel free to check it out. And number 2, you can also profit from the capital growth and it will be reflected in their share price, especially for companies that don't pay dividends such as Tesla. And if you buy low and sell high later, then that difference between the sell and the buy price is technically your capital growth. But all said and done, still, the main way people benefit from stocks is by buying and holding them for the long term. And investing legend Warren Buffett recommends holding stocks for decades. The patient investor will be rewarded, he said. And for what it's worth, here's my stock portfolio that I regularly update and share it over on my Instagram profile. So feel free to check it out, but as the earlier disclaimer applies, invest based on your own investment goals. So which US stock will you be purchasing? Will you be implementing the top-down or the bottom-up approach? I'm excited to hear how you will kickstart this journey. Do let me know in the comments down below, and I hope you find this video helpful. Thanks for watching, and as usual, I will see you in the next one.